Vice President Equities at Lorne Steinberg Wealth Management. It's great to see you.
Morning, Andrew.
Just on 23andMe, I was never tempted to let them have my DNA.
Me neither. So I'm amazed they're actually looking to sell that on to somebody else. Are they going to get the approval of the individuals to give that data away? I wouldn't have thought so.
I wonder, is it going to be sold on a so-called anonymous basis? But yeah, I was never interested in doing that.
That's tricky stuff, yeah, very confidential.
What is attracting your attention in the market right now? What's of most interest to you, Mark?
Yeah, trying to avoid the noise.
Right.
You know, when I'm sitting at dinner table and my wife's asking me about tariffs, then we've had too much time talking about tariffs. And
you're joking. She does she ask you about tariffs?
Occasionally, yes.
Okay,
yes,
okay,
she does.
fine.
And it's just, you know, we're in this world of noise, and who knows where this is going to go.
Yes.
We've talked about it before. Tariffs are bad. Bad for the country that's imposing them, and bad for those that are. How it ends up, nobody knows. So I'm trying to look through that. You know, are there opportunities today in the market for companies that have been beaten down stock prices because of tariffs, and ultimately they'll be okay, or for those companies that we have to care about tariffs almost. So there's always opportunities in the market. You just have to look a bit closer for them sometimes.
Now, you on the surface, tariffs look inflationary. I mean, they will raise the price of certain goods in countries imposing them, all other things being equal, to use that cliche. But you think that's a bit simplistic? They don't necessarily mean inflation and higher interest rates?
I think it's interesting. If you look at the HST giveaway that we had, you know, over Christmas and into the new year from the government here, no one suggested we should cut interest rates because headline inflation dropped. And it's the mirror image in terms of tariffs. Tariffs will increase headline inflation, but ultimately will exert a deflationary force. Tariffs are a tax on imports. There'll be less money to spend. Ultimately, they will be deflationary over time. It's a bit like a higher oil price. Headline inflation rises, but long-term ultimately exerts a more deflationary force than inflationary.
Do you think, I mean, who knows what goes on inside the Oval Office, but do you think part of the motivation here is to raise revenue by putting on a de facto sales tax?
It's interesting. If you look at what is he trying to do? He's trying to bring manufacturing back to America and to raise revenues from imports. They are mutually exclusive. You can have one or the other, but you can't have both. Because if you're manufacturing cars in America, then you're not able to levy imports on those imports which have now been substituted by American manufacturing. So the math simply doesn't add up. And if you look at some of the numbers about replacing personal income tax with tariffs, it's not even close.
You are a great reader of history, a study of patterns of the past. Looking back over multi-decades, you say, and of course, we can always mine statistics notoriously. I'm not saying that you're doing that. But last year, I think this is for the S&P 500, there were 57 all-time highs. And typically when a year gets to 50-plus record highs, it doesn't bode well for the following year.
That's right. You can accuse me of mining statistics for meaningless reasons. I absolutely admit I am guilty of that. But yes, if we look at 2024, 57 all-time highs in the S&P 500. All-time highs are not necessarily a bad thing, but in years where we've had more than 50, going back to 1928, the subsequent year of returns was roughly 3%. 3% down on the market over the subsequent 12 months, suggesting that a lot of all-time highs doesn't necessarily lead to good long-term returns or even good short-term returns. And it's the same as, you know, the starting point is the valuations I've mentioned before. We came into this year with high valuations, particularly in the US, and we're maybe seeing some of the fruit of that.
So stocks still pricey?
In the US, if you look at the cyclically adjusted price-earnings ratio, I talked about it earlier this year being in the 95th and above percentile. With the correction we've had, if you look over history, we're still in the 90th plus percentile. So we're not in bargain territory, not even close.
So arguably, if somebody was to start an equity portfolio right now, they might be advised to put money in gradually?
I say that to my kids because they've got a 50-year time horizon. So put money in every month. The market goes down, even better. The US is one market. Yes, it's 60% of world equities. It's a big market. It's got by far some of the best companies in the world. You don't only need to own the market. You can own international stocks. You can be selective within the US. There's always opportunities. As I say, you just get away sometimes from the headline. This is the Mag 7 there's 490 other companies in the S&P 500, some of which look quite interesting.
And we have this result, I think a lot of people would not have expected. Stocks are up in Europe this year, doing just fine despite the trade war.
Yeah, who would have thought? I mean, Germany's probably one of the economies that's going to be hurt most. The auto sector certainly by the trade war. They're suffering because of the lack of cheap Russian gas, etc. And the stock market's one of the best performers year to date. Again, it matters what valuations were at the beginning. There was so much apathy surrounding Europe, the economy, and the stock markets. They could only ever go up.
You have some stock ideas for us. Canadian National Railway. You would think at first glance, aren't they vulnerable to a trade war?
Absolutely. They're down 20% over the last 12 months because of that vulnerability to trade war. About a third of their business is in the US, 2/3 in Canada. Ultimately, the trade war will resolve itself some shape or form. If you think of CNR, it can be political interference, it can be bad harvests, it can be wildfires, and here we are with a trade war, limiting trade for a period of time. Ultimately, we will get through that. Long-term investor buying CNR on 17, 18 times next year's earnings. Beautiful duopoly in Canada. Why wouldn't you want to own it for the next 5 or 10 years?
Corteva, the big supplier of farm chemicals, seeds, and crop protection chemicals. You like the look there.
We need to feed the world. Corteva has about 2/3 of its business in seeds. So really fancy stuff that it's doing with seeds, hybridization, etc. Drought resistance, and then you've got the crop protection chemicals business. They were spun out of the merger of Dow and DuPont. They are one of the few leading remaining independents in crop sciences. We need to feed the planet. The planet is growing. There's a lack of arable land. You need better seeds. You need better crop protection chemicals. These guys do both. Offering something like maybe 15% earnings per share growth, paying 20 times for it. Don't care about tariffs.
And Kenvue, a spin-off from J&J. You take issue with the name here. It's a portmanteau word.
It is. I think it's the worst named company that we own. Kenvue comes from the Scottish word for knowledge, you can, and the French word for insight, view, Kenvue. I mean, who came up with that? Probably paid someone $1 million for that. That being said, the business has a lot of brands that we know and love. Listerine, Tylenol, Band-Aid, etc. It has some great brands that have been around for decades and will be around for decades. Never going to have stellar growth, solid, dependable growth, very stable margins, high free cash flow. And now, under independent management, we think they can do a little bit better than they were as part of J&J.
Martin, always great talking to you.
You too, Andrew. Thank you.
Martin Cobb has been our guest today.